in this trade war, which country has the most to lose, the United States or China? Here to debate, Gordon Chang. He's a columnist for the Daily Beast and the author of The Coming Collapse of China. Also with us is John Rutledge. He's the chief investment officer at Safanad. John, let me start with you. The U.S. stock market pretty sanguine this week about the prospects for a trade war, but the Chinese stock market is not. We've seen some big indexes down 7-8% so far this week. Is the market implying that China may be the first ones to blink here? What's your view of this?
Well, that's definitely true in the stock markets because Chinese markets are heavily influenced by foreign capital flows. And the capital has been flowing out of China, which has been encouraged also by the higher interest rates the Fed is pursuing. So I think the capital market story is there. But there are two other angles in China that matter. One is the economy, and the third one is the politics. In the economy, China's got a higher growth rate than we do. And it's not in particular influenced by the trade policy we've had so far. But most important is politics. Xi doesn't give a hoot about the poor people in China. Why do you think they attacked soybeans? Not just because of our farmers, but because he doesn't care about the pressure from his own people. This is a very different place in China than it is here. And you have to know the politics to understand what they're going to do. That's why they retaliated.
Gordon Chang does understand the politics. You've studied it for a long time over in China. How aggressive do you think President Xi and the Chinese are going to get or can stomach getting with the U.S. in this trade war?
Well, over the long term, most Chinese academics and analysts think that Beijing cannot win a struggle with the United States. So for Xi Jinping to prevail, he's got to basically bluff President Trump in the short term. Right now, Xi Jinping's in trouble. There's a lot of dissent in the Chinese political system. It's manifesting itself openly. You have these essays. You have people coming out and criticizing the president. And the reason is Xi Jinping has grabbed control of the economy, which means that when the economy goes well, things are really great. But when it goes poorly, it's a problem for him. And you've got to remember, China in reality is growing about 2%. We're growing at 4.1%.
Where do you get that number?
Well, if you start to look at 2016, which is where we've got a full set of numbers, the World Bank said that China grew 1.1% when they claimed 6.9. And that's consistent with total primary energy consumption, which showed that China grew basically 1.4% in 2016. 2017, that number went up a little bit, so maybe they're growing at 2.5%. But that's really the extent of their growth.
John, you were talking about politics over in China, but there's politics here in the United States as well. There are many in the Republican Party who do not agree with President Trump's position on this. There's the midterm elections coming up. Might the opposite happen? Might President Trump blink first?
Well, the pressure's here. Obviously, there's the red states, the farmers, the soybeans, and all that. But the fact is, 2/3 of the largest exporters from China are foreign-owned firms. General Motors sells more cars in China than they do in the U.S. right now. 1/3 of the value added of Chinese exports is from U.S. firms. So that's where the political pressure would come from here, is from U.S. firms that don't want the tariffs to screw up the sales they're making in China to Chinese consumers. 50% of the service component of U.S. imports is the domestic content as well. So car dealers, car repairmen, guys like that, those are the vulnerable spots here in the U.S. But the truth is, trade wars can go on for a long time. A lot of people get hurt. Best estimate I've seen is the trade we've got on the table right now probably would cost the U.S. 1% of GDP. That's about $200 billion. That's getting to be real money.
So let's go through China's arsenal of tools that it can use to fight back. It's not just tariffs, right? We've seen them block a deal, or at least not weigh in on agreeing to a deal with Qualcomm, NXP. What else do they have?
Well, there's so many ways they can go after U.S. companies in China, Sarah. I mean, they're just innumerable. We've seen these discriminatory law enforcement actions. We've seen new regulations in the national security area that are meant to target U.S. tech companies, whole range of things. But a lot of Chinese officials don't think that Beijing should be using these because it'll have a discouraging effect on investment from Asia and from Europe. That's really critical, basically, for the Chinese. And so there's a lot of hesitancy in Beijing right now about doing the things that would be the most effective.
And of course, China's Apple's a critical part of Apple's overall strategy. I'm sure Tim Cook is not sitting down letting this happen on its side. He's very much involved in these negotiations as well.
Apple is the one U.S. company that is vulnerable to China from a whole number of reasons, especially for supply chain. But a lot of other companies, they can move their supply chains very quickly. And as a matter of fact, that's already been occurring for a very long time. So I don't think the U.S. consumer, apart from those who buy Apple phones, are really going to be affected that much.
John, do you think the Chinese realize this, how fluid the global supply chains? This has already happened. Sneaker manufacturing moves out of China, moves into Vietnam, now maybe moving into Africa. The supply chains have proven fluid long before this trade dispute.
Look, this is an I love you, Gordon, but comment. I'm on 7 boards of directors, including companies in the auto sector. It is not possible to move a supply chain at a snap of a finger. We've spent decades building global supply chains. Yes, people do their very best to try and dodge around these trade disputes that happen. But the fact is, if you, not the tariffs, but the red tape surrounding non-tariff barriers, if you hold up containers in a port, waiting for somebody to inspect them, to tariff them, and to sign the papers, inside those containers are parts. And those parts go on assembly lines. And you can shut down an entire assembly line for lack of components in products. So those are the kind of things nobody knows how to forecast because nobody has a really good map of all these supply chains. But that's the trip up that could happen in global economy. It's the same problem as they're facing with Brexit, is you just don't know what's going to happen to the things moving through the ports and how fast or slow they move.
And yet the U.S. market, investors there don't seem that concerned.